Options trading can be a powerful tool for investors seeking to diversify their portfolios, hedge risks, and potentially amplify their returns. However, without a solid understanding of the different options and strategies available, it can be easy to get lost in the complexities of this financial market. In this ultimate video, we'll break down the most popular options trading strategies, explain how they work, and offer tips on how to apply them effectively in various market conditions. Covered call strategy. The covered call is one of the most common and straightforward strategies in options trading, especially for beginners. It involves owning the underlying stock and selling a call option on that stock. This strategy works well in a moderately bullish or neutral market, allowing you to earn extra income from the premium received for selling the call option. To execute a covered call, you first need to own 100 shares of a stock. Once you have your shares, you sell a call option on those shares. The buyer of the call option has the right, but not the obligation, to buy your shares at a specified price before the option expires. In exchange for this right, the buyer pays you a premium. If the stock price rises above the strike price, you may be required to sell your shares, but you still keep the premium as additional income. On the other hand, if the stock price stays flat or only increases slightly, you keep both your shares and the premium. This strategy provides income through the premium and offers some downside protection. However, your upside is capped because if the stock price rises significantly above the strike price, you will miss out on those additional gains. Protective put strategy. The protective put strategy is a form of insurance used to protect against a decline in the price of an underlying asset. It's typically used when you already own a stock but are concerned that it might decrease in value. In this strategy, you buy a put option on the same stock to limit your downside risk. The protective put works by allowing you to sell your stock at the strike price of the put option, even if the stock's price falls below that level. The cost of this protection is the premium you pay for the put option. If the stock price does decline, the put option increases in value, offsetting some or all of your losses. However, if the stock price rises, the only loss you incur is the premium paid for the put option. This strategy is ideal for investors who are bullish on a stock in the long term, but want to limit their potential losses if the stock falls. It provides a safety net, but the downside is the cost of the premium, which can add up over time. Long call strategy. The long call strategy is one of the simplest and most popular ways to trade options, and it's used when you are bullish on an asset. When you buy a call option, you gain the right to buy an underlying asset at a specific price before that option expires. If the stock price rises above the strike price, you can exercise the option and purchase the stock at a lower price, then sell it at the current market price, profiting from the difference. If the stock does not rise above the strike price, your loss is limited to the premium paid for the call option. The key benefit of this strategy is that it offers unlimited profit potential with limited risk, as the most you can lose is the premium. The long call strategy is ideal for investors who believe a stock will rise in value over a certain period, but are not interested in owning the stock outright. However, time decay can erode the value of the option, so it's essential to choose the right expiration date and monitor the stock's movement closely. Long put strategy. The long put strategy is used when you expect the price of an underlying asset to fall. In this strategy, you buy a put option, which gives you the right to sell an asset at a specific price, the strike price, before that option expires. If the stock price drops below the strike price, you can exercise the option and sell the stock at a higher price, locking in a profit. If the stock price doesn't fall, your loss is limited to the premium paid for the put option. The long put strategy offers a way to profit from a declining market while limiting your risk to the cost of the premium. This strategy is a good choice when you believe a stock or asset will experience a significant decline, but you don't want to short sell the asset or risk unlimited losses. However, just like the long call, time decay can work against you, reducing the value of the option as expiration approaches. Iron condor strategy. The iron condor strategy is an advanced option strategy designed for neutral markets. It involves selling an out-of-the-money call and put option while simultaneously buying a further out-of-the-money call and put option. This strategy profits when the underlying asset remains within a specified range, avoiding large price movements in either direction. To set up an iron condor, you sell a lower strike put and a higher strike call, creating the short put and short call positions. Then you buy a further out of the money put and call, creating the long put and long call positions. The goal is for the stock to stay within the range of the short positions, allowing you to keep the premium as profit. This strategy works well when you expect the market to remain range-bound or for volatility to decrease. It limits both your potential profits and losses, as the risk is contained by the protective options you've bought. However, the maximum profit is capped at the net premium received from the trade, and you must accurately predict the range in which the stock will move. Straddle strategy. The straddle strategy is used when you expect a significant move in the price of an underlying asset, but you're unsure of the direction. In a trade, you buy both a call option and a put option with the same strike price and expiration date. This strategy profits from large price movements in either direction. If the stock rises, you can profit from the call option, and if the stock falls, you can profit from the put option. However, if the stock price remains stagnant, you will lose the premium paid for both options. The key to success with this strategy is timing, as the stock needs to make a significant move to cover the costs of both options. A straddle is ideal for times when there is high volatility or when you anticipate news events that could drastically affect the stock's price, such as earnings reports or mergers. However, the risk is that time decay will erode the value of both options if the stock does not move as expected. Butterfly spread strategy. The butterfly spread is a neutral strategy that profits from minimal price movement in the underlying asset. It involves 3 strike prices and typically consists of buying 1 lower strike option, selling 2 middle strike options, and buying 1 higher strike option. The goal is for the stock to end up at or near the middle strike price at expiration. If the stock stays within the range of the middle strike price, you can profit from the 2 sold options premiums. The maximum profit occurs when the stock is at the middle strike price at expiration, and the maximum loss is limited to the premium paid for the spread. The butterfly spread is best used when you expect little movement in the underlying asset's price. It's ideal for range-bound markets, but it can be complex to execute, especially for newer traders. This strategy offers a limited risk-to-reward ratio, making it a more conservative option. Options trading strategies offer investors a variety of tools to manage risk, increase income, and potentially profit from both upward and downward price movements. Whether you are looking for income generation, downside protection, or speculative opportunities, understanding these strategies is crucial for your success in the options market. Remember that options trading is not a one-size-fits-all approach, and each strategy has its own set of risks and rewards. It's essential to assess your financial goals, risk tolerance, and market outlook before choosing a strategy. By mastering the fundamentals and applying these strategies wisely, you can enhance your chances of success in the world of options trading. If you found this guide helpful, don't forget to subscribe for more in-depth content on trading strategies and financial education.